Today's episode is brought to you by Cruve, a card and digital wallet service. You'll be hearing more about Cruve later on, but for now, let's get into today's interview. I'm joined once again by Tian Yang, CEO of Variant Perception. Tian, great to have you here.
Thanks for having me.
Tian, so much I want to get into, but just you've been on the show before. Just remind people, Variant Perception, it's a macro research shop. What is your process? How do you go about analyzing the economy and markets?
Yeah, sure. So, our research philosophy is this idea of man plus machine beats man or machine alone. So, we spend a lot of our time trying to build models that work over different time horizons, from tactical trading models to try and time the market over the next 1 to 2 months, through to cyclical models of the business cycle. So leading indicators of growth, of inflation, real-time recession models. They typically work over a kind of 6 to 12 month period, and longer-term structural models that tend to look at the capital cycle, capital flows from industries to industries, demographics, and currency cycles. So those are more kind of 3 to 5 year views. And then ultimately our job is to synthesize the output from these models, so you can marry up the cyclical with the structural, and then use the tactical to help a bit with timing, kind of position entry to express themes. So hopefully that gives you a rough sense of how we think.
Yeah, that's good. So longer term as well as shorter term. Let's stick to the next year. What's your base case for 2023?
So I think the interesting thing is our recession models for the US economy actually triggered at the end of 2022. So the way we define the recessions is we essentially built these to predict in real time the probability that any given month will be dated an official recession by the NBER. So obviously we know in practice, the NBER tends to date recessions with a quite long lag well after the fact. So we've essentially trained our models on the historical NBER dates using a combination of hard and soft data inputs to try and pinpoint the start of recessions in real time. So as of now, the US recession model is triggered, which joins basically Europe and China in recession territory as well. So obviously that sets us up for a pretty risk-off environment. So, obviously inflation going lower, growth going lower, good for bonds. So that's kind of the main base case going into the year. And in terms of the plan for how to buy back into risk assets, we've essentially set out a 3-step process where usually the sequencing goes, step 1 is policymakers panic, right? Things go bad. There's stress, obvious stress somewhere that forces a policymaker panic. That's usually the first sign. And then that tends to, around that policy panic is when you also get a lot of just reliable technical buy signals going off. And it's more about the breadth. So, we're tracking, signals across, single name sectors globally. So what you'll tend to see is a massive, breadth of buy signals going off, in line with kind of the stress in the market or the economy. So that'll tend to be point 2. And then the third and final piece will usually be after you get the buy signals, after you get the initial policymaker easing, eventually liquidity, growth, lead indicators bottom out and start to turn up. Our market bottom checklist models will start, seeing more items checked off, and the recession model recedes. And that'll be kind of the final all clear to kind of then go max long. So, I think right now it's very risk off for the year. And the plan to get back in is basically contingent on 1, policymaker panic, and then, true selling exhaustion signals. And then finally, the kind of, cyclical lead indicators turning up.
So we're headed into a recession very quickly if we aren't in one already. And you have a short-term bearish outlook, but you have a plan for going long as the recession develops. I just want to ask you a question about a recession, because people started talking about a recession. I mean, some people always talk about a recession, right? But about maybe 9 months ago, people started talking about a recession, and then you had 2 consecutive quarters of negative real GDP prints, which, on Wikipedia and other places is kind of the technical definition of recession. So leading many to declare a recession. And I was convinced that, we were in one. However, then the economy, in the third and fourth quarter rebounded with extreme alacrity, you can say. And also a lot of that is just because inflation went down, and, nominal GDP was always positive, but inflation was so high during that, Q1 and Q2. So yeah, so now for example, so one, do you think we were in a recession at all in 2022? And then also, now the Atlanta Fed's GDP now estimate is at 4.1% quarter over quarter from I think Q3 to Q4, and 4% annualized GDP, real GDP growth. That doesn't sound so recessionary to me. So what's the difference between your models and the Fed's models?
Yeah, sure. So I think the key thing to think about is what are the very volatile components of GDP versus trying to extract the underlying trend. So I think when we're talking about recessions and the things you want to worry about is when private consumption investment ultimately trend lower, right? And that's going to affect profits. That's going to affect kind of asset prices. The problem is the data's obviously, had quite noisy swings with inventories, with trade. And I think so from quarter to quarter, that tends to mess up the data quite a bit. So for example, on something like the Atlanta Fed GDP now, if you go in and strip out things like inventories and net trade, which by the way, over the long run tends to just swing around zero. But if you look at things like private consumption investment, they swing around 2.5%, which is obviously generally accepted trend rate of growth. If you strip that out, then the first half of last year, even on the GDP now, wasn't a recession. And today the number's much lower, right? It's more like, below 2. And obviously it's still going to be volatile, but the trend is undeniably just going lower. So I think, it's important to bear in mind the specific method. It's not that the Atlanta Fed model is wrong per se. It's more the model was designed to predict GDP as printed, right? But GDP as printed has lots of these volatile components that isn't necessarily super helpful in real time to give you a read, right? Plus, it's obviously GDP is a very heavily revised series anyway. So again, in real time, you can't really use it. And it's not just that our models are somewhat bearish, right? A lot of the other regional Federal Reserve Bank models are actually a lot more bearish than the Atlanta Fed, right? Like the St. Louis Fed models, like gone to zero, obviously. The Philly Fed, it's not as frequent, but they do projections, right? And that's pretty bad as well. So it's more. It probably looks more like the Atlanta Fed models is a slight outlier just because, it's got like a big boost from predicted inventories, right? That's helping to boost the GDP number. So, yeah, so I would say that's probably why the divergence looks so egregious right now. But if you strip it out, the underlying slowdown is still kind of in the data. To us, again, as I said, the model only triggered end of last year. So really, there wasn't a recession in 2022. But we think this is basically the beginning now, right? So this is when we're just about at zero, we're going below. That's essentially what we say is about, what this month is going to look like.
Yeah, a lot of economic measures are so messed up if you measure them on a year-over-year basis because of COVID, like personal income, because everyone was getting checks to the unemployment rate to non-farm payroll, stuff like that. So you have a bearish case for 2023 on stocks, on risk assets. One of those cases is because of the recession. What else? I know you do a lot of work on liquidity. Liquidity's very bad in 2022. Is it still bad? And how negative a force is that for the market? And how do you measure liquidity? Important.
Yeah, so our excess liquidity measures are still a very bad level. So these are what we consider cyclical indicators for kind of the next 6 to 12 months. They're typically looking at global narrow money growth minus inflation minus real economic activity, right? So essentially, it's saying how much money has been created system wide that isn't really being used up for real activity or to support basic inflation, and whatever is left over tends to support asset prices. So last year, obviously, equities and bonds were down together. That usually makes sense when excess liquidity goes very negative because there's just no money to support any asset prices. As of right now, it's still pretty negative. But actually, I would frame it a little bit differently in that, when you want to position, the key is that to bear in mind the 6 months bearish outlook, but then you probably need to be slightly more tactical in terms of actual positioning around it. So the setup this year is more on a 1 month basis coming in is more a bear market rally makes sense because you had quite strong outflows in December. We had a bunch of buy signals go off on tech basically end of last year. And obviously with the inflation peak story, the initial focus in the market is probably going to be on peak inflation, peak Fed policy rates, and people trade that narrative to drag the flow up. But obviously as the data deteriorates more through Q1 into Q2, then the kind of growth slowdown story will probably get a bit more prominence. And then I think equities, that's when you see the real big downside. But obviously, falling inflation, falling growth, both are kind of going to be good for bonds. So I think that's why it's more clean right now to think about expressing the risk of view by more being long bonds than it's necessarily just sticking with a short equity throughout the year. I think equities, you always going to have to manage the bear market rally risks. And, that's going to involve a little bit more trading around, really. So.
Okay, right. So we've got look the chart that we're showing right now charts liquidity in red advanced 6 months relative to real GDP. So when liquidity goes up, GDP goes up generally. Not saying they're necessarily causing each other, but they're very correlated. I'm sorry, but so central banks do quantitative easing. They expand their balance sheet, putting cash, bank reserves into the system. That moves up liquidity, and then liquidity goes down when they do quantitative tightening, as many central banks, including the Fed, are doing now. So what is in your liquidity measure other than QE versus QT?
Well, actually, that's not a measure. By the way, I think it's the chart below what you share on the screen. I think when we talk about excess liquidity, it's just things like central banks only go in implicitly. Yeah, that's the one. So the key point is that we live in a fiat money system, right? Where money creation is not just the role of central banks. Commercial banks have a big part to play in that. And so if you're only watching central banks, you're missing the impact that commercial banks can have on credit creation, right? And so oftentimes when you learn about money in the textbooks, originally it's this idea of fractional banking, like central banks control reserves and that affects credit creation, right? Whereas obviously in practice, it's not a binding constraint and it's a lot more, it just happens a lot of times can be independent of central banks, right? Central banks are affecting animal spirits. So that's why I think for us, we measure it essentially M1 or equivalent level, right? So then you capture both demand deposits and currency in circulation, right? And that gives you a broader sense of the right kind of definition of money as it affects kind of future activity and future asset price performance, right? I think it's a very important point here just to know, when people talk about how to measure money, I think there's a sweet spot where, for example, people look at M2 to GDP, right? But M2 includes a lot of savings deposits. And so if savings deposits goes up, potentially that drives M2 up. But savings deposits going up isn't necessarily bullish, right? Because people are parking money away in kind of, longer term, locked up money, and it's not available to spend. Whereas if you track narrow money, it's basically just demand deposits and cash, right? Like generally that doesn't go up unless there's a lot of activity going on and people want to do something with the money. And then once the activity stops, that demand deposit falls, and then then they can save it or do whatever else that they want. So I think there's a sweet spot where if we want to define liquidity as it pertains to kind of forward-looking asset prices and forward-looking activity, right? And if you just do central bank balance sheets, sometimes you'll miss the impact that commercial banks will have on money creation and animal spirits, right? Like this is why the classic chart Fed balance sheet against S&P worked up until whenever it was 2016, right? And then it diverges because you're missing some of the other pieces of liquidity, really.
Right. Okay. So Tian, you've got so much fascinating stuff, and I want to, the audience is going to love all your stuff. I want to smack it into an hour, but I really just can't help myself. Talking about liquidity, isn't it? I know with M2 explodes higher when there's quantitative easing because even though the monetary base, Federal Reserve money, is not counted at M2, what they do is the Fed buys a bond from JP Morgan, and then JP Morgan, to restore the bond that it now does not have, it buys a bond from me or from you. And then suddenly I have a bond and I don't have excuse me, I don't have a bond and I have deposits, right? So isn't it pretty similar? Because like the Fed is buying bonds from banks buy bonds from you, so now you have more money, and that doesn't that come up of an M1 or does that not?
Because M1 will react as well, right? So obviously, if you go plot the series, M1 will react, but the one times when there is a divergence, that's when like the M1 data is going to be a bit more reliable. I think even the conference board themselves have done studies. So I think 30, 40 years ago when they first started building leading economic indicators, M2 was included as one of the leading indicators. And over time, they've revised it out as well. So now it is only, more narrow definitions of money that included.
All right. Well, so now let's not bury the lead. Let's look at these variant perceptions, countries, LEI, a liquidity indicator, something like that. Euro area in gray, very negative. China, negative. US, negative, but not as negative. So it doesn't look like there's anywhere that's safe where there is liquidity. Yeah, just break that down. Why is liquidity falling in different regions, and how might that differ? And also, do you think that Chinese liquidity will go back, as many, including people who invest in Chinese stocks, because the stock market is surging now, are expecting that China will restore liquidity?
Well, yeah. So what you got up here is the growth country lead indicators. So as you suggest, the growth outlook across the board is pretty poor right now. From a liquidity point of view, because money is going to flow across borders, right? It's very hard to pinpoint exactly where the marginal benefit is going to be. But I think we try and think about it as more of a global concept. Hence, the chart you showed before with global excess liquidity. With China specifically, clearly you do see the policy impulse has shifted and turned positive, and it's been shifting up since kind of what Q3, Q4 is already shifting up. But the key thing to note right now is that the kind of negative drag from US policy impulse is so negative, it's going to, it's currently overwhelming the Chinese indicator right now. So the net message is, yes, China domestically, that's clearly going to be a rebound, right? Like if you reopen, it's obviously going to, you'll get kind of a little bit of the revenge consumption, all those things. But in aggregate, the global kind of stimulus pool, the global liquidity pool, based on all the data, is still shrinking. So that's why I would frame it as China isn't going to help support global reflation in the way it did in 2009-10, when the magnitude of the impulse was just so much bigger back then. And even today, if you think about this reopening and you look at the US experience, obviously what happened was, yes, people spent a lot more money, but there was obviously a lot of inflation as well. So in real terms, not all categories of expenditures managed to get back up and go back above trend, right? A lot of things took a while to come back to trend. It's really only, I think, in things like clothing, in like restaurants, hotels, right? Those are where, you get a lot more bang for the buck, where the excess savings come out and get spent. So it's not going to be like a across the board kind of relief for everything, right? So in China, I think it's going to be a lot more important to focus in on segments that are still below trend, where the marginal savings can be unlocked, right? Durable goods, clothing, and then hotels and accommodations. Probably those are going to be more where you'll see the up moves.
Right. And so your view of liquidity, that it's low and in many areas getting even worse, that informs your asset allocation decision that risk assets will perform poorly. High beta will underperform low beta. Stocks will underperform bonds. We can get back to liquidity, but now let's talk about the business cycle and the recession. Let's stick to the US. We can move on to Europe and China. So I think recession is defined as like a broad-based decline in economic measures of spending, investment, production, employment. Many of those, if not all of those, are pretty strong in the US now, particularly the labor market. I mean, the unemployment rate is at 3.5%. Which areas of those four, or you can add others, of the economy, do you think will be the first to be very weak? So much so that, people who aren't looking at leading indicators, but are actually looking at like hard real-time data, will note it.
Well, it's already happened, right? Housing and manufacturing are the two. Obviously, manufacturing is still the more leading part of manufacturing. It's the surveys, ISM surveys, so forth, is decline, right? Like the coincident data is just about peaking. But yeah, housing, manufacturing to start with. But even in things like labor markets, right? Like the more leading parts of labor markets already are moving. If you look at temporary workers, that's kind of declined back to zero. Job openings rolling over, right? There's a lot of the leading parts of even labor market data tells you, the stress is coming. Even for the US consumer, right? The whole narrative, there's a bunch of excess consumer savings, so the US consumer is fine. Again, if you look at the more, like the higher frequency data, right? The household pulse survey from the Census Bureau, right? Like across the income spectrum, all the way up to like $100,000 household income. There's you can see, right? There's rising, kind of difficulty paying bills. So what I would say is actually the behavior of the data is in line with what it should look like on the eve of at the beginning of the recession, right? Because we're not talking about the depths of recession here, right? When you're in the depths, that's when the line is obviously very, very low. And that's usually obviously when policy easing is probably already kicked in. And that's kind of the contrarian buy signal, right? Today is more like when you're just crossing below zero, that this is kind of what it should look like, where it's pretty much across the board. It's all the leading parts in the leading indicators across most of the economy have gone to bad territory. The coincident data is still fine, but it's basically been, going sideways or started rolling over. And then obviously in the, through Q1, Q2, as data is released because of the lags, presumably by March, it'll be a lot, you start seeing a bit more obvious signs of broader kind of data stress, right? That will be the sequencing.
Right. So that chart that we were showing earlier is the Census Bureau of percentage of survey respondents having difficulty to pay expenses by income, paints a very different picture of the strong consumer balance sheet narrative that was supported by the very high amount of deposits in bank accounts. Not even necessarily people with $10,000, but people with $100, thousands of dollars. Now let's look at the ISM manufacturing, which is a measure of manufacturing activity. Above 50 indicates growth. A high of 60 means business is booming. Below 50 indicates contraction. 45 or 40 indicates a recession. So that's in the black line. Now manufacturing is at 49, and also we since this report from Very Perception was released, I think we had a services that was just over 49, indicating that services are contracting too. So yeah, explain that, the ISM manufacturing in black, and then explain what it leads, the durable goods inventories ex transport, as well as the spending chart that you have on the left.
Yeah, sure. So I think this is a pretty intuitive relationship when you think about the inventory cycle, right? Or, sometimes we call it the bullwhip effect. So ultimately, if you get a huge buildup in inventories, where businesses obviously, during COVID over-ordered because they wanted to secure their place in the queue of the factory. They over-ordered, got delivered all the stuff they thought they were going to sell in anticipation of higher demand. But if that demand doesn't materialize, suddenly they sell too much inventory, there's going to be discounting, right? And obviously we saw a lot of that with US retailers in the second half of last year. So if you aggregate up the measures of inventories, then it's pretty intuitive that it actually leads future manufacturing activity. So the red line there, you can see the right-hand axis is inverted. So the red line going down basically means there was a surge in inventories last year. So because there was a surge in inventories, typically that will lead with a lag to slower manufacturing activity in the future, right? Because there's inventory that needs to be digested. And so, that's.
Oh, yes. Sorry. So the red line has an inverted y-axis so that when it's down on the screen, that indicates inventories are actually going up. So inventories were increasing by 10%. And that makes sense. You see companies like Lululemon, not to pick on them, but their inventories went up. I'm not going to say over 100%, but it was a very high percentage relative to 2021 because, oh my God, stuff is flying off the shelves. We don't have enough stuff. Now they have enough stuff, and the amount of stuff that they have has exceeded the amount of actual consumer demand.
So this is a classic bullwhip effect, right? And obviously it's called that because you get that whip action at the end. And it was massively exacerbated by COVID. So COVID is causing the mother of all bullwhip effects in terms of sequencing, right? Because during COVID, when, it's only Chinese factories open whenever it was in 2020, and you put in your normal order for, 100 pairs or whatever, yoga pants, right? And they tell you, oh, we can only do 50 pairs for you. So what do? You order 200 thinking you'll get 100. And now you got 200 pairs, right? You'll get these exaggerated bullwhip effects as a result of kind of the over-ordering that COVID caused. So that's why I think the inventory cycles, quite a big risk this time in terms of sequential step down in growth. That probably isn't going to be anticipated.
Right. Okay. So, we've got two parts of your sort of trifecta of bearish indicators. One part, liquidity. We talked about that. It's bad and getting worse. One part is recession. You think a recession has already started, and if it hasn't, it's going to start, momentarily. The third factor, let's talk about the Fed and interest rates and the terminal rate. How does this play into your perspective?
So obviously with these things, you need an anchor to start somewhere. For us, the anchor for the analysis has always been the idea that the Fed has never stopped their hiking cycle until the Fed funds rate is above the trailing year-on-year CPI historically, right? And it seems a pretty intuitive thing to us to at least have as that initial anchor. So, on current kind of projections for where the month-on-month CPI is going versus what's discounting the Fed funds curve, you're basically going to get to like March, April, right? The Fed funds will get to basically 5 or 5.25, somewhere in that range, right? And then the year-on-year CPI core and headline should be below that by kind of April or May. So the idea is that that's at least kind of the initial target point for when the Fed can. That's kind of the earliest they can go on pause, essentially. And then from then, obviously, we'll need to see how quickly inflation can come off for the Fed to be able to pivot. And on most of our models, if we think the recession started, but the Fed keeps hiking into the recession, then presumably by kind of May, there'll be a bit more evidence of actual economic stress, and there'll actually probably be some room for the Fed to actually ease a little bit, right? I think that's that's basically the current I would say the current kind of game plan. We'll see. Obviously, we're having.
You're saying, and this is a great point. I think Stanley Druckenmiller has also made it that it's never happened that the Federal Reserve has pivoted without the Fed funds rate going above CPI. Right now, CPI is the headline figure is 6.5%. We're recording on the day CPI came out. So the Fed will either have to hike to 6.5% or above it, which I imagine would be disastrous for equity prices. Not necessarily, but probably. Or inflation has to fall to wherever the Fed has. So if the Fed peaks at 4.75% or 5%, inflation will have to fall there. So this perception that, the Fed's going to stop at 4.75%, that's only going to happen if inflation falls to 4.75%. Yeah. So, and that might take a while,
Yeah, so there's two moving parts, right? But I think on current trends, you're going to get there by May, plus or minus a month by next year. So
May 2023.
Yeah. So The key point right now is on inflation. Again, this is where I think the time horizon matters a lot. Where I talked about a cyclical 6 to 12 month horizon and a structural. So I think on the structural horizon, we still think there'll be a higher equilibrium level of rates and inflation, right, 5 years out. But if you're talking next 6 to 12 months, it's pretty unambiguous that every lead indicator of inflation, both demand and supply side, has rolled over very sharply, right? So on a cyclical basis, this like an overwhelming amount of evidence across most of the piece of inflation that inflation is going to come off. Obviously the one area of divergence remains housing, but I think even Powell himself made some references to how it's it's not being accounted for correctly. I think it was in the Brookings. One of his Brookings speeches or something. So, if whether you're looking at it from a supply chain point of view, look at it from like a food price, energy price, right? Because obviously, ultimately, inflation is a year-on-year number. You look at it from a demand point of view, it's all pretty much rolling over. So I think it's more converging with inflation coming down while the Fed slows down its pace of hikes, right? And then it meets.
Hey there, I hope you're enjoying today's show. Just wanted to let you know that this episode is sponsored by Cruve, a payment service that gives you power over your finances. The way it works is that Cruve is an extra layer on top of your credit and debit cards that gives you additional cash back on the rewards that you're already earning. Cruve Card has no foreign transaction fees, and you can choose to earn your rewards in crypto. You don't have to, but you have the option. Cruve Card also has a feature called Go Back in Time, where you can retroactively change the card used to buy an item after you made the purchase, up to 30 days after, actually. A key concept in finance is optionality. When you have the option to do something, but you don't have to do something, this can be very valuable in finance as well as life. And optionality is exactly what Cruve gives you to do with your wallet. So check out Cruve to get $20 once you've downloaded the app and made your first transaction. Cruve Card is powered by Hatch Bank. Terms and conditions apply. Now let's get back to the interview. Now let's talk about inflation. How rapidly do you think inflation will fall? And I know a big factor of disinflation over the past 6 months has been energy. Do you expect that to continue, or is that kind of just luck that it's pretty warm in the winter in Europe this year? And then also shelter. Just how lagging is that? It's going up 0.8% every single month, and the way that that's calculated may suggest that it will continue to advance even if the underlying rent doesn't go. And you know what I'm talking about. So what do you think about inflation?
Yeah, so obviously any given month is gonna the numbers can be volatile, but as I said, it's pretty unequivocal. And obviously, this is a report from December, right? So we've had some more updates, and all the lines have kept going lower. So I think it's pretty unequivocal. Inflation is slow quite a lot. Like I said, in terms of the month on month, it's probably not going to go much more than 0.3 a month, right? So that annualized to 3.6. Obviously, this is going to be somewhat contingent on our recession views, and clearly we think that we're going to recession, and so that's why you see even on the slide, right, where we think ultimately the recession is going to be the demand destruction plus the relief from supply chains. That's kind of the core setup for the inflation outlook. Now, the complicating factors will be how much of an inflationary impulse China does create, depending on how aggressive that easing becomes, right? But so that's the one area of path dependence where you kind of have to observe a little bit. Clearly, given how fast and disorderly China's reopening was, there is the range of potential policy options suddenly seems a lot wider, right, than it did a few months ago. So it's not out of the question that they could just really stimulate super aggressively, right? Because clearly something's happened, right, that they can't stick to all Xi's signature policy. So.
Yeah, and just about China, are you noticing any economic indicators? Not an article saying some Chinese official of the Chinese Communist Party whispered this to some journalist. Not that, but actual a yield, a price, something like that, that indicates that reflation within China is on the way. One thing I'll say is the price of copper. People have been saying very bearish copper since June, and it was right for a while as the economy was slowing. But the price of copper has exploded higher over the past month or so. Not to the highs of early 2022, but pretty close. And that to me may say, hey, China could. That's a sign of economic strength. So is it? Are you noticing any signs of economic strength in your data that you can attribute to the Chinese reopening and the Chinese perhaps restoration of liquidity?
So I think in terms of hard economic data, not yet, because obviously these things take time to feed through, right? It's going to be slightly lagging if it's a purely policy-driven thing. But yeah, in terms of market prices, obviously you mentioned the commodity rebound, things like Chinese big bank performance relative to the index. That's typically led out of a lot of the big previous bear markets, and that has so Chinese banks are basically led on the way up. So yeah, there's a few things there, but I think that the concern I would have is if you look at a lot of the flow proxies we have, this really needs to be like a legit policy shift, right? Like it's quite a lot of speculative flows. Like on our flow proxies, the amount of cumulative buying is basically back to where it was in July and August of last year, right? That was like the last time when it was China's bottom and people got back to that level. So right now we're at an interesting tactical point, and it's really dependent on policy follow through. Now, I just think it could happen. It's just more the distribution of outcome is a lot wider, right? Like I don't think anyone would have thought it would be this disorderly where every signature Xi policy is kind of suddenly gone. So that suddenly opens up the possibility that if they're not hitting real estate so hard, they suddenly want to give tech room. Maybe they're open to doing massive stimulus, right? There might be a chance of going something more akin to like a 2016, 2009 style big easing of liquidity. In which case, then obviously you'll get all the confirmation, right? And you'll be correct. But I would say that that's kind of what we're looking for to kind of sustain the rally.
Okay, thanks. Now let's move on to your asset allocation. And if it's okay with you, can we show this sort of checklist just of what you think should be underweight, neutral, and overweight? So let's start with the underweight section of you should be underweight equities and underweight U.S. high yield credit. Why underweight? And I guess the mathematical model-based approach is, oh well, my model says it and my model is right 88% of the time. But if I were to ask you, if you're right and in a year equity prices and high yield credit has underperformed the less risky things that you recommend to be overweight, like cash, why do you think you will have been right? Is it because earnings actually went down? Is it because input costs, labor costs went up and the top line didn't go up by enough? Is it because interest rates are so much higher so that the value of future cash flows is worth less on a discounted basis? All of the above. Why are you underweight U.S. equities?
Well, firstly, it's equities relative to bonds. So if you want a really, really simple rule of thumb, if you just look at where yields are, where bond yields relative to earnings yields, and you look at that over over a very long period, that tends to lead kind of relative performance. So obviously, when yields back up enough and equity valuations don't come down as much, that relative value already helps you in terms of which way you tilt. But for equity specifically, the work we've done on earnings recession is that historically earnings recessions don't matter unless they're part of a broader general economy-wide recession. So the idea is that if you don't get a economy-wide recession, then when earnings go negative, that's the contrarian sign to buy, right? The only time you get a cascade fall in earnings or the cascade kind of knock-on effects is when earnings fall and is part of the economy-wide recession, because that's what sets off the feedback loops. And so,
sorry, what's an example of a time where earnings fell, but the economy didn't fall, so it was a buying opportunity?
I think 2018, I think it was, I think it got close. I'll follow up with you afterward. I think there's been quite a few historically where it just about goes negative over the past 50 years, and that's usually the buy sign. But obviously, a lot of times earnings collapse as part of a economy-wide recession, right? And as we talked about, economy-wide recession is really about when there's positive feedback loops that start to kick in, right? Now, when all these job losses happen, but the job losses now lead to falling consumer spending, so suddenly corporate earnings are worse. Suddenly now banks demand they have to pay more credit spreads, which then causes further stress, right? I think those are the feedback loops that cause that initial fall in earnings to turn into something bigger. Whereas normally, if you don't have those feedback loops kick in, then obviously the initial fall, it'll just stop. So I think that's why the risk is more tilted towards potentially a lot more of these cascade effects that go on this year. And so, if you just say finger in the air, right, typically equity is going to, at the market bottom is kind of 15 times is normally when you would trade. And you can apply like a 15 times to like what a forward earnings estimate should be. So right now, say like a 220 on S&P, right? So, that gives you like a rough sense, right? If you apply 15 and you say forward earning estimates 4 to 200, that's like 3,000 on S&P, right? So I would say, we don't think this is like a 2008 where, the bank's going to go bust or anything like that, right? There's like the bank balance sheets are clearly a lot better. Like structurally, it's kind of a different setup. And obviously you've already front run some of the bad news with, crypto, with tech, profitless tech, right? You've already seen a lot of deflating in kind of the higher duration assets. So, I think it's more about the fact that earnings might stay down, and then the multiple people assigned stays down because it's a recession kind of environment, right? I think that's more the outlook rather than thinking this is going to be, that the central, policymakers aren't going to come in and save the market eventually.
And how do you think about different sectors? As you alluded to, some of the biggest drawdowns in 2022 for stocks were in the technology sector, high valuation stocks, profitless tech stocks, stuff like that. If we are in a recession, do you expect that to continue? Because I feel like a lot of the reason that those stocks suffered so much is because interest rates rose up so much. But if we have a recession, I imagine we're not getting to 6%. Then if you don't think that, do you think they would outperform? And which sectors will suffer the worst? You typically think of as cyclical sectors like energy, financials, sort of what's your sector outlook in terms of the best and the worst?
So to your point, again, this is where the time horizon matters a little bit. That's why I said earlier, if you're talking about a 1 month outlook, you can see a lot of things lined up for a short squeeze in tech, right? Obviously, we've already seen that in the first 2 weeks, but I mean that could go for another few weeks, right? Where the narrative will be inflation's peaked, rates has peaked, these high duration things benefit. But obviously, the problem is when you look a year out and the economy is going worse, then earnings do matter. And if earnings are going lower, then it's hard to justify kind of where you were trading previously. So I think for us overall, it's a lot more of a defensive. We probably prefer a lot more defensive. Some of the more reasonably valued staples. I mean, it's a bit difficult, right? The challenge for equity investors in this environment is that quality names are generally expensive names, right? And that was a problem last year, right? With a lot of these names that got hit. So, but broadly speaking, we'll say, you want to hide out in more defensive sectors, right? But it might be a little bit more, you need to look a little bit at single names. The interesting phenomenon right now is actually it's more the large caps where things are looking a little bit more vulnerable. If you actually look outside, the S&P 500, the biggest US names, and you look at the distribution of forward PEs, it's actually looking a lot closer to what a market bottom would typically look like, where there's already a huge cluster of things trading at like 10 times or lower. But it's more like
you got these fantastic charts. What are we looking at here?
So this basically shows you the distribution of forward PEs for single names at different key moments in the market, right? So the black line is basically what they look like at the 2009 bottom, and the gray line is the 2020 bottom. So the point here is that usually at a major market bottom washout moment, you'll tend to see a huge cluster of stocks trading basically under 10 times PE. Right. And so
PE is price to earnings ratio. If a company's worth $1 billion and they make $100 million in profit, they have a PE of 10. If analysts think that they're going to make $200 million next year, they have a forward PE of 5. And when you're at a market bottom and things have sold off so much, it makes sense that a lot of stocks are trading at a forward PE of 6. So yeah.
And so you can see on the right-hand chart that's got the Russell 3000. So obviously it's capturing most of the market, and the distribution is a lot closer to what it looks like at the bottom, right? Whereas on the left-hand chart, it's got the S&P, and you can see, the red lines. Well, that was obviously December. It won't have changed that much. So you can see the distribution. You don't have that fat tail at the left, which you should expect to see if it was a genuine kind of washout bottom moment. So, there's more relative value in probably small caps, international names, if you go and do the work and look, right? And those are probably like the valuation low enough you can hold it and kind of hold through. I think it's just more S&P large cap names. I think that's where, even though it was bad last year, it probably won't get better this year.
Although during recessions and vicious bear markets, isn't it safe to say that small cap stocks and international stocks tend to underperform big cap tech stocks in America?
Yeah, so I think this is the really interesting thing about the current environment, where essentially what we're doing is two aspects, right? One is you're trying to analyze what we would call fundamentals, right? That would be understanding the business cycle, understanding the earnings cycle, understanding the capital cycle. And then the second piece is what I would probably say playing the game. And playing the game is all the trading stuff, right? Your trading tools, your flows, your positioning, the crowding measures, what are funds holding, right? So it's about balancing the two. And I think what you're seeing right now is that from a playing the game point of view, there's certain areas that are very, very bombed out. That's probably got a lot less kind of selling. That's got less selling pressure, right? Because it's being sold very hard already, right? So I think it's more the playing the game aspect of the market that's leading you to those areas. But obviously from a fundamental point of view, they're clearly not going to do great, but obviously a lot of it is in the price. So I think that's the point.
And tell us, you got this great bottom checklist for when you're in a bear market, stocks are going down. This is a checklist you look at where if a lot of things are checked, as in they're green and they say yes, in this case, that means you might be close to a market bottom, i.e. it's time to buy. So right now, I'll just take a look. So over 6 months of net selling, yes. Over a 20% decline in the S&P ratio to the Dow Jones, yes. COPOC near zero, I don't know what that means, but it says yes. Plunge in consumer confidence, yes. Expectations over current are positive, yes. So those are things that would suggest it's a bottom, but then you have several other things that are not yet checked. So tell us about this.
Yes, just to clarify, the 20% decline is literally just the standard bear market definition. So peak to trough 20%. It's not.
Oh, it's not the ratio of S&P. It's S&P 5 or Dow Jones. Got it. Okay, sorry.
So the checklist is basically intended to be, when can I just close my eyes and buy equities and forget about it for the next 2-3 years, right? That's kind of how I think about this. It's kind of when all the longer term things are lined up. And so I think the key point is that top line, where usually at major bear market bottoms, the Fed has been easing, right? And because the Fed's been easing, you've had the curve bull steepen. So you've always had curve steepening. And so that's the key missing piece this time around. And I think that's a very critical piece. The bond rally reversal is basically a similar idea, right? Where usually there should be a big recession scare where bonds rally, a huge flight to safety. And then you start to recover from that flight to safety because of essentially Fed easing, right? So that's why you have the initial bond rally and then the reversal. That's kind of what it is. And then the 18-month RSI is similar to the COPOC. These are kind of using monthly measures. So it's looking at very, very long-term oversold, oversold conditions, essentially. So essentially what this is telling you is that, yes, from a price action point of view, we are somewhat close to a bottom, but you're missing kind of the policy pivot, right? Well, I said earlier, the policymaker panic, right? That's usually the safest thing because, that's like a catalyst in a way. And yes, they might ease and then you start rallying, but then even if you buy in 10, 15% off the highs, I think you can feel a lot more comfortable that once they start, then the entire chain of events that sets into motion sets up the market for like, a good rally for next, two plus years, right? So this is a different.
So for you to become bullish on stocks and for you to think that there's a market bottom, you need to see all of the things that are currently marked no in the 2022 category happen. So you need to see a positive shift in monetary policy, aka Fed pivot. You need to see a bond rally reversal because bonds rally during a recession, and you need to see the RSI relative strength index on the 18th month below 30. What is a COPOC near zero?
So that's basically a technical indicator. I think it was like a priest a long time ago who invented it. And the idea was that he said bear markets are a little bit like a grieving process where, you go through the various stages of grieving. And what he noticed was that in his role as a priest, it took people 11 to 14 months to get over the grieving process. So he essentially used 11 months and 14 months as inputs into this indicator to proxy for the kind of mourning process people go through when asset prices go down. So that's a very long-term indicator, but it's been quite reliable historically. So again, it's just a way to confirm that prices are down. Obviously, there's a limit to what indicators you can pick because we want to take this back to the 60s, and there's not that many data series back to the 60s, so that's really why it's on there. But if you ask me, I would highlight the really important things to pick out is that you've had a sustained period of selling, and then a Fed policy pivot, and then the bond market confirms it. Right, that in my mind is an even simpler way to kind of go about it, really.
Right. So just to simplify your asset allocation, underweight equities and high yield. You like bonds, you like cash, and you like U.S. rather than emerging markets. You like the dollar. Let's now move on to
Actually, the one thing that's changed now is I think we've gone overweight gold. I think we've had an incredibly rare setup for some of our gold fundamental models that suggests it's probably the start of a new gold bull market right now. So the conditions are finally in place. I think a lot of our stuff wasn't that positive on gold last year, but you're kind of finding the sweet spot because I think there's a misconception that gold's supposed to be an inflation hedge and it does well when inflation's high. But even in the 70s when inflation was super high, you still had like 40% crashes in gold, right? And actually what we found is the optimal time to buy gold is when real yields are peaking, when policy rates are peaking, when the economy is about to turn down, and when gold miners basically been underperforming the gold price for a while. That's actually a much better combination of what that gold's going to do well on a forward-looking basis. And you've basically just had all that line up in January. So I think, that's probably like an interesting shift right now.
Even though inflation is falling.
Yes. The key point is that it's not just about inflation, it's about real yields. It's about real yields and nominal yields and the economy. It's not just inflation on its own. It's just one of the pieces goes into it.
Right. Okay. So I just skipped through the section where you said your view on Thailand, your view on Brazil, and if people want all of that specifics, they should subscribe to Variant Perception. Let's talk about the bond market. If you think there's a recession, you think inflation will fall, you want to own fixed income, no credit risk, treasuries, other sorts of sovereign bonds. You can buy a 1 month treasury bill. You can buy a zero coupon, 30-year bond. Where on the curve do you like stuff?
So I think it depends if you're a levered or unlevered investor, right? So if you're just a cash investor, at this point, you've given where yields are, you've got quite a lot of protection from your carry, right? No matter which part of the curve you pick, right? Obviously, if you go for lower duration, you're going to struggle to like not make money, right? Because if your duration is like say 2, all right, if you're buying like 2 year or 3 year, then you're going to pick up your 4%, right, for the year in carry. And then you would need like a really big move in yields for you to lose that, right, in capital gains. So I think for the most part, if you're unlevered, it's not that, it's actually fine, right? It's not going to make a huge difference to you. I think it's a reasonable time just to allocate. The trickier question is more like if you're a lever player, if you're a swaps trader, what do you do, right? And this is why right now it's quite a tricky environment, because if you're a swaps trader, the carry for steepness is incredibly negative right now. But from a directional point of view, this is the time you should really be thinking about putting steepness trades on. So I think this is where
sorry. Let me say so. If you're a levered investor, you borrow short term you borrow overnight, in the repo markets to buy a 10-year treasury note. And if the 10 year is yielding 3.5%, but the repo rate, the overnight rate is 4.5%, you're losing 100 basis points annualized every single day. So it's a negative carry position, right?
Yeah, and a lot of this is basically discounted into basically the swaps curve, right? So you can look at basically where spot yields trade, but you also look at where the forwards are, and basically there's a huge gap, right? And I think that's the tricky part when you ask that question today, because if you look at 2s, 10s, 1 year, 2 year, 4, right, they're a lot less inverted than where the spot is, and I think that's the tricky part where I think timing is going to be quite important. So you almost need to. This is what links back to what we were talking about earlier with the Fed. You almost need to probably just sit on the sidelines for a little bit. Let's get a bit closer to kind of the February, March point, right? The point at which the Fed funds and the CPI are going to cross. And then that's a much more comfortable point where you don't have to have as much negative carry to get your position on. And hopefully, right. I think that in my mind is kind of what's going on right now. Like the basic short answer is you want to be starting to look at putting steepness on, right? Because you should be putting steepness on the eve of a recession usually, because basically what's going to happen from here is the economic data gets worse. Eventually everybody realizes and there's a lot of stress, and then policymakers ease, right? The tricky part is just the carry isn't great today.
Right. Okay. So now we're showing in this chart your fair market value for the 10-year bond is 1.7 or 1.8%. Again, this report is from December of 2022. Maybe it's higher or lower now that we're recording in January. But and right now the 10-year Treasury is about 3.5%. So buying the 10-year Treasury note would, if you're right, would have positive returns. The only question is when. So what is your outlook based on timeline of when bonds are going to rally? Do you think they stay flat for 6 months and then explode higher? Do you think that they start grinding higher?
Yeah. So first of all, that's the scenario for a recession, right? So that's obviously assuming. So the way we get to that number is we input a lot more numbers that you see at the depths of recession into the model, and that's what spits out to, right? On the trailing basis, I think 3 to 325 is more where a fair value is based on trailing numbers, but obviously on the forward-looking basis, assuming we're right on the recession, that's basically how low it can go. In terms of the timing, I think you're absolutely correct, right? It's only going to move when policy rates move, right? And so there's going to be that's why in the first half of this year, it's more you have the position on, you probably won't lose that much. You can pick up the carry, but it's only going to have the big move once the Fed starts cutting rates, right? And that's going to really drive it. So, I think that's and you get the bull steepening, right? So, basically the entire curve will yields come off. So, yeah.
Right, so now let's talk about the long end. Let's talk about the shorter end. You said by June 2024, Eurodollar call spread. Tell us about that.
So this is a way to level up the recession view with cap downside. So, if we're right on recession, then obviously, by June 2024, there's going to be, that's plenty of time for there to be evidence of the economy slowing down. And right now, obviously, there's not, the policy rate is still discounted to be quite high. So you can level that up by doing a call spread. So you're effectively betting that the Fed's going to cut, but you get a very asymmetric payoff if they do cut, essentially. That's the idea. Obviously, this is moving around a little bit, but the idea is that this is a cleaner way to bet that there's a recession and that the Fed's going to cut, but you don't have to deal with a lot of negative carry things, right? This is just you just pin the Eurodollar June 24 future, you just buy the call spread wherever it's trading, right? And that's your fixed amount you pay up front. And you don't have to worry too much about, the carry and the things swinging around, and you just try and hold it. And you just hold it so that if there's a deep recession, they will cut and it'll just pay out. So that's the basic idea here. You can see on the chart, right, the implied probability that will be at 2% in the mid of 2024, is very low. and so that there's scope for that to go up.
Right. And since writing that, I think that trade has worked well, which makes me nervous because, that's like close to 200 basis points of cuts are hiked in from the terminal rate in the spring of this year till the end of 2024. So it's just like how much more you expect it to go. So you're betting against Powell basically by doing this trade. And if you don't know about this trade, I mean, I would say don't do it. Like it's advanced trade for advanced investors. I'm not an advanced investor. I've never done a trade like this. So just a warning for my audience. Now let's move into commodities. So you, Tian, and your firm, Variant Perception, very early for calling for a commodity super cycle during 2020 when everyone was so bearish and thought that interest rates would go to negative 2%. You pretty much stood alone. I mean, there were others calling for a commodity super cycle, and that has turned out so beautifully, Tian, that now everyone thinks that oil is going back to $100. What do you think?
Well, I think that was the timing when I last came on the podcast, right? When we said, it's time to get out. So I think that
you're right.
I think that timing is being pretty good. So, I think the message remains from what it was, when we spoke last summer. Structurally, from a capital scarcity point of view, clearly the bull case remains for, oil and gas, for energy. But you just cannot ignore how severe the cyclical headwinds have been. Now, obviously, with the China shift, we are clearly on high alert to see if some of the models start to shift, right? And, as you mentioned, a lot of industrial metals have rallied quite a lot off the lows. And there's clearly some other elements with, potentially countries trying to, just stockpile, build up inventories, right? So there's some of those elements in place. So I would say, right now it's a bit more neutral. Again, for me, to really get back on the trade, I just want to see some signs of relief on the growth front, right? Because right now, basically the growth outlook basically can't get any worse. Now, the good news is if it can't get any worse, the next marginal move is it's going to get better, right? Like you can't have US, Europe, China all in recession and all the LEIs being so bad. But the problem is I just don't know the timing. So that's kind of what I'm waiting for. And, and obviously everyone's very focused on China. So I'm trying to see when our China models start to shift. And right now it hasn't shifted. So I'm just waiting for that as a potential catalyst. And then that'll be a sign to try and revisit.
Right. Okay. So this chart that we're looking at right here is key. It's the capital scarcity cycle for energy. So when the bottom is that's capital abundance. The top is capital scarcity. So there still is a scarcity of capital in the energy sector, but that's on the supply side. On the demand side, you just think there's demand destruction and stuff like that. Yeah, my question is about China. When people say, "Oh, China's reopening, they're going to be using a lot of oil," but then I also hear people saying, "But they've been buying oil and their inventories are very, very high." And I actually have not been able to find. I'm sure the data exists, but I haven't been able to find that Chinese inventory data. So, how do you think China's reopening, if it does happen, will affect oil demand?
Yeah, I think you're going to struggle to probably find that data, given how it's probably quite geopolitically a sensitive topic. But if you take a step back, you have to imagine they're going to be stockpiling, right? If we're in an environment where China and the US obviously have poor relations and there's going to be a lot of geopolitical competition, it's going to be important to secure resources, right? That's going to be needed to keep your country stable, let alone for whatever, competition you want to do for, semiconductors, renewables, whatever else, right? So you have to imagine there's a lot of stockpiling going on, whether, even though we probably can't see the data. But like I said, on the reopening, even just looking at the US experience, the tricky thing is that in real terms, things might only just get back to trend, right? Like if you look at things like, transportation, actually we're a bit below trend, right? Even in the US after so long on reopening, because obviously there's legacy effects, people work from home, right? Some of those things, the expenditures might not actually get back up to the same level. So, yes, it will be higher, but it's probably, as of right now, probably not enough to support the overall kind of demand picture for oil, right? What I would go back to is that policy stimulus chart, we talked about earlier, where the US policy stimulus, and this is across both credit and fiscal policy, is so negative that at the moment it looks like it's going to overwhelm the positive China data so far. So, if that changes, then that's probably going to be more optimistic for oil. As of right now, it hasn't, but that could change in the coming months.
Tian, is it safe to say that if your view, which is increasingly becoming the mainstream view on inflation, that inflation will continue to fall at a brisk, a fast pace, if your view isn't right and inflation goes back up, is it safe to say that the most likely reason it does go back up is because there's another oil shock or another natural gas coal shock?
Yeah, well, I mean, it's anyone's guess, right? For sure, given the supply constraints, then yeah, if there's a move, then clearly, it's inelastic, right? That can move. There's risk from food prices going up. I mean, right now, all signs that food prices at peak should roll over. Fertilizer prices, a lot of these other things linked to food inflation. Food manufacturing costs, right? A lot of those things are rolling over, but clearly with something like food, it's going to be weather dependent, and we've not had the best growing season, right? So like the USDA put out surveys on like soil moisture conditions and a lot of these things, and there's been quite a lot of bad readings. So there's some stored up stress for food potentially, right? But obviously, the tricky thing is you don't know about the exact impact because it depends on how much inventory there is and whether the inventory for food gets drawn down. So yeah, I would say if it happens, food probably more likely than energy, just given weather disruption. On the goods side, I think it's pretty unequivocal, right? Most of the signs for goods is rolled over. And then services will be the one thing where labor shortages continue potentially. So that services inflation, wages just hold up even if the economy slows down, right? And, I'm in the UK and, based here, we've just had strikes constantly for the past few months, right? Even though the economy is doing badly, interest rates gone up a lot, people are still striking. And there's, just shortages all the time. So that's something that, again, can prop up wages potentially. So those are probably some of the moving parts. But, basically, you have to break down the cyclical versus structural. I still think most of the structural factors suggest that we are in a more inflationary environment, but it's just more the cyclical factors in terms of the relief versus last year just looks so big that you should get more of a down wave this year in inflation.
Tian, what is a view that you have on asset allocation that would surprise me given my knowledge of your economic thing? So, you like bonds, if you told me you like bonds and you don't like equities, I could presume you'd like the dollar, right? Because it's a risk off thing. But is there something that's sort of, weird or, most people don't follow that you're either long that is kind of contrary to your macro view or you're short contrary to your macro view,
Well, actually, I mean, on dollar and gold, that is probably worth talking about because that's probably a lot more nuanced, right? So on dollar, technically, dollar does statistically, it goes up during recessions, right? But the reason it goes up is because there's safe haven inflows into the US because it's a safe haven and there's inflows from Europe, from China, wherever else. The tricky thing this time is that safe haven inflow already happened last year, right? Because Europe and China went into recession before the US. In normal cycles, it's the US that leads and then causes a recession in the rest of the world, which then sucks money into the US as a safe haven. But because China chose to lock down themselves into a recession, right? Obviously, the war drove Europe itself into more of a recession. So they already had the recession first. You had the safe haven money inflow into the US. So you probably won't get as much of a dollar move rally this time, even if there's a recession, just because it's kind of already happened. So I think that's also why technically you probably don't want to just go out and mega short the dollar right now, but it probably won't actually do that much, right? And if the dollar doesn't do that much and we have all these things on gold, then actually being on gold makes a ton of sense.
But aren't you pretty long? Don't you like the dollar? I thought it said overweight.
Yeah, it's a medium overweight, but if you read the text, I think the point is technically you should be, but I would say it's a low conviction and there's a lot in the price because of the dynamics I described.
So you're saying it's I see what you mean. It's not a bright green. It's a moderate green. And why do you like emerging markets?
Sovereigns,
sovereign bonds, for example.
Yeah.
Typically, like when you're in a recession, South African bonds tend to do quite poorly. So why now?
So it's more linked to the fact that in pockets of EM, they front loaded the hiking cycle in 2020 and 21. So they hiked much earlier. Their real yields are much more positive. Inflation lead indicators in some countries like Brazil have sharply rolled over. Obviously, that was our top trade, one of our favorite trades last year, although I think it's quite consensus now, it feels like. I mean, I think it pitched quite a lot, quite a lot of places, but that doesn't change the dynamics, right? Inflation rolling over, hiking cycles are peak, there's room to cut. And the best time to buy bonds is when the economy is doing badly, but starting yields are high, right? That's the perfect combination because there's room to cut. And so I think in LATAM, in Brazil, right, for example, it's looking like a very attractive setup. So yeah, that's why I think EM bonds, you're gonna get the benefit of the cuts basically.
So you said the long Brazil, you thought of it, and other people who I respect also thought of it, but now it's become consensus. Like it's a victim of its own success. Brazilian stocks, I think they had one of the best returns for countries in terms of the equity market in 2022. What do you think is the most overrated macro opinion now, or what's the most crowded trade? Whatever, however you want to put it.
I don't know. Do you have some prompts from I guess like soft landing, mild recession? That feels like a majority opinion right now. Mild, yeah.
Yeah, well, soft landing. I mean, sort of 4 months ago, if you asked me about a soft landing, everyone who I talk to, who I know and have respect for their opinions of, most of them, with the exception of a handful of people, thought soft landing was just it's something you say if you're on TV, but it's no one actually believes in the soft landing. But I think the economic data, at least in the U.S., has been very resilient. I mean, the unemployment rate's at 3.5%, and it's continued to even go lower. So yeah, I mean, why is the soft landing unlikely? Do you think?
I think this comes back to the leading versus lagging data, right? So for example, the unemployment rate is one of the most lagging indicators, right? So obviously, if you plot it against recession bars, you'll see the unemployment rate peak like basically after the recession is over, right? So people keep getting fired even when the economy is turning up again. So I think that's probably a part of it driving the divergence. But yeah, I would say it feels more like soft landing seems quite a popular opinion. So therefore, equity is the bottom. So you should buy S&P. I feel like that's actually becoming a lot more prevalent as a theme. Like I said, I think it'll work for the next month or two because the flows were so bad. The outflows were so bad in December. But if the economic data deteriorates as we think by February, March, then obviously there's more downside from there.
How bad were the outflows in December? I'm just observing the S&P 500 like everyone else here. I don't have these flow data, but the S&P started selling off seriously shortly after the Fed meeting in the middle of December, but I didn't notice anything strange. Tell me about those outflows.
Yeah, so I mean, we're tracking. So there's a couple of ways we track flows, right? One is we're looking at just the dollar value traded in up and down stocks every day within all the indices, right? And you can look at the cumulative differences. That would be one. You can also proxy for what is a speculative outflow versus patient capital, right? So obviously, when patient guys trade in the market, what tends to happen is they tend to sit in the order book on the bid offer. And then when lots of volume goes through, the price doesn't move, right? So you can observe this because essentially intraday liquidity goes up, intraday volatility goes down when
they have a lot of limit orders in. Like Warren Buffett told his trader. I like this. Warren Buffett has one trader who does all of this stuff. Yeah. I like that.
They just sit there, right? So tons of volume will trade and the price won't move, right? So you can observe that. So you can attribute that most of the trades that day to the fact that there was a lot of patient money in the market. Right. Conversely, when more speculative guys come in the market or people who basically have shorter term horizons, they need to get their trade on, right? So they're going to cross bid offer. And obviously, even the act of crossing bid offer means that, they're causing more intraday volatility, when they trade, right? So that's how you can differentiate. So I think it's more, when you look at it in September, not only dollar value wise did you see a lot of outflows, you also saw quite a lot of speculative selling in terms of the price action. It didn't. So that's why, on our models, you're getting down to like a contrarian level. It wasn't as bad as June or October, but close to it. And then obviously end of the year, you had, some of the buy signals trigger on a lot of the tech names. So I think that's why the bear market rally can potentially go for a little bit more. But obviously as that sucks, the flows back in, like already this year, I would say we've recovered more than 50% of the outflows already. Right, in terms of the dollar notional value. So, we're probably getting not far away from then sucking all the money back in. And then obviously from there, then no more marginal buyers again. And so, yeah, that's probably the point of more vulnerable equities.
Right. All right. Tian, before I ask my final question, I just want to say that people should follow Variant Perception, your firm, on Twitter at VRNT Perception, variantperception.com. Yeah. Tell the audience, tell me a little bit about what you offer clients, and do you have different tiers? I know you just have a sort of a new platform that you're excited about.
Yeah, so we think of ourselves as essentially offering an investment portal to speed up your investment process. So we offer a lot of our tools and reports via the portal, so you can look up our lead indicators, keep on top of which of our signals are triggering. The company has been around for more than a decade, right? So we've been building various models over the past decade. So it's just accumulated models for the economy, for trading different asset classes. And so, at this point, we think of ourselves as more just like a full stack kind of model. So there's somewhere you can go check, right? So, if someone pitches you, I don't know, like a short on a European paper company, you can go on that, you can go and look up, what does VP's capital cycle longer term model say? Is that a good long term short, right? Someone pitch you the Eurodollar trade, you might want to go look up, our inflation indicators. Does that make sense? So I think it's more I think of it as hopefully like a resource to answer a lot of investment questions. The portal essentially came from us figuring out a better way for our internal analyst team to use our tools better and to access it a bit easier. So, so essentially I would describe it as we basically write reports based on our tools, but we also provide access to all the tools. And so that's kind of the full service, really. We tend to target ourselves as more institutional clients. And follow us on Twitter.
Well, there we go. Tian, my final question for you is, I think it's about the biggest disappointment of trades in 2022. I say the biggest disappointment of 2021 was being long gold. Biggest disappointment of 2022 was being long volatility. The S&P 500 was down 20%. Probably a little less than that in 2022. But the VIX, sometimes it went up to high 30s, but it immediately went back down, and volatility really did not perform as an asset class. And also with the VIX, remember, you can't, as of course, you can't buy the spot VIX. You have to buy VIX futures, which are frequently in contango. So like if you look at UVXY, you lost a ton of money. So volatility was not a good hedge. Options on the index did not do well because of, low correlations between assets. Obviously, some options on individual stocks like Carvana did extremely well. But do you think the VIX, as we approach into a recession, will finally start performing, or will it continue to fail to be a diversifier?
Well, I think on a lot of the more structural models, I think the upside is fairly clear. So typically VIX and credit spreads are highly correlated, right? They basically move together. And so what typically leads credit spreads is fundamental deterioration. So when corporate cash flows go negative relative to the stock of debt outstanding, that usually leads to credit spreads widening. So that's basically been happening. So that's kind of suggests fundamentally the VIX is biased higher. But obviously, in terms of dynamics trading day to day, your guess is as good as mine, right? I've seen lots of theories last year, from all the negative gamma is pinned here, is pinned there, people overhedge. Who knows what the truth is, right? But I would say from a fundamental point of view, things are a lot more in place now to support a wider credit spreads, which is basically the opposite side of the coin to the VIX, right? So that's normally how I think about the VIX.
Right. I think that's a really good point. And I would say maybe I was a little bit too harsh in describing volatility as a quote failure, as part of a well-balanced portfolio. You always have things that do better than others. Well, Tian, it's been an absolute pleasure. Thank you so much. And thank you everyone for watching.
Yeah, thanks for having me on, and speak soon.